Welcome to the February edition of the Peters McGregor Webcast. I'm your host, Research Director Nathan Bell. Today I'm joined by our CIO, Wayne Peters. Welcome, Wayne.
Good morning.
We'll just put the disclaimer up. As always, all care and no responsibility. Just give that a few seconds to make sure it can be taken as read. Okay, so we'll just start off very quickly going through the recent performance. We've had a reasonable 6 months there, slightly ahead of the index. I think most people tend to look at the 3 and 5 year track record, and there we're essentially in line with the market. I think a lot of people are questioning active management at the moment, and the response we generally have to that is that the index has been, particularly in the US, has been very strong since the GFC, and even still we've got those big growth stocks that are still driving the market. The FANG stocks that we often talk about, which is the Facebooks, Netflix, Amazons, etc., now have a market cap of 1.5 trillion US dollars, which is just truly remarkable. But the one thing we would say to people is we expect over the 5 years, in contrast to the past 5 years, that the stocks that we own, we're very comfortable with the valuations despite the richness of the overall market. And when people finally decide that they're not going to pay any price for any stock, or potentially if the growth slows down for a couple of those giants or juggernauts, then you'll start to see some dispersion between the index and the performance of not just our fund but value managers across the board. Just moving on to the portfolio's top holdings. I'm not going to go into a lot of detail here. We've got 4 stocks we're going to talk about in a bit of detail shortly. There hasn't been any major changes since our last webcast in November. The main one is that we sold Bank of America. Bank of America was a long time holding for us. Quite remarkably, last February it got down to $11 a share, which was just a ludicrous price in our view, not just because we had a view on interest rates going up and certainly weren't predicting that Trump would be the new president, and then looking for a higher interest rate, more inflationary economic environment, but just because it was a wonderful franchise that was making $20 billion in pre-tax profit, and it was just a wonderful business in a much more consolidated industry than what it was pre-GFC. I'm sure you'll appreciate the irony that despite everyone worried about banks being too big to fail, they've only got bigger since the GFC, but right across the board in the US, the balance sheets of banks are much, much better than what actually probably at record capital levels, interestingly. And I think one of the benefits of the banks we might see from here is more capital returns. But we're value investors and we want a margin of safety in the valuation of every company we buy. And we thought at around $20 that was fairly full value for Bank of America, even though it's gone up a little bit since. But you're really relying on higher interest rates to drive higher profits for Bank of America from here. And our view is that potentially they're not going to go that high that quickly anyway. So we sold Bank of America and we still own Wells Fargo, which we'll talk about shortly. So Twitter's one that we've written up in the quarterly recently. It also had its results in the last couple of days. We've outlined the case for it before, but I'll hand over to you, Wayne, if you could just give us the basic investment case and then perhaps how you thought about the recent results.
Yep, thanks, Nathan. We're very excited about Twitter. Here is a business that has been established as long as some of its major competitors, and yet the market valuations, are a fraction of the competitor base. It has just over 300 users, 300 million users, but clearly a large part of that are problematic, a lot of bots. What we've seen in the last earnings call is that the fundamental direction of the growth in the business is very, very positive. The short-term performance has been viewed quite negatively and gave us an opportunity when the stock price fell back to add to the position. The daily active use growth remained very strong. Impressions and duration were both up in double digits. So the fundamental thesis to our investment is that the user base does not need to grow significantly. They just need to fine-tune and take the money that's being spent on R&D and make it more productive. what we've seen is the revenue growth has been tremendous since they've started to monetize the site, but the expense line is still far and above what it should be. And the two main areas which need to be railed back in is the R&D expenditure and the expenditure on stock options to their staff. These have clearly got out of hand. They were as high as 1/3 of revenue. In the last quarter it's dropped to 25%, and the board has clearly targeted this expense to be reduced. They're targeting that to drop to the high single digits, but in our view it can go even lower than that. Bill Gates recently commented on reflection of his time at Microsoft, and he said one of the biggest mistakes he made was once the business became strong in its own rights and no longer a startup, the amount they gave in stock options to their employees were far too high, and if he'd had his time over again he would have had much lower issuance of stock options, and I think that's very much going to be the case with Twitter moving forward. If anyone is really interested in the story, the background to where this company is today, Hatching Twitter is a book I would highly recommend. And the thing that struck me when I was reading that book was that management made some awful blunders. And there was high turnover in the C-suite, and even with those blunders and mistakes, this business just continued to roar forward. I think Zuckerberg from Facebook made the comment that Twitter was like a clown car that fell into a gold mine, and we believe that gold mine is very much in existence, but with a market cap of around $10 billion US, less than, simply a couple of percent the valuation of the Googles and Facebooks of the world, we believe the upside is very significant. And so the recent earnings call simply solidified our view and our thesis on that name.
As a value investor, I think when you're looking at businesses or investment opportunities, what you really want is a plan A where you make a lot of money, and a plan B where hopefully at worst you don't lose too much. And a couple of things we like about Twitter is, one, you've got billions of dollars of cash sitting on the balance sheet. So management need to make some tough calls here, and we question whether Pat Dorsey was the man to do it, having been the original founder, but we've seen he's been markedly cutting costs and cutting the workforce, which is actually a really difficult thing to do for anyone who's actually run a business, no matter how big or small. Letting people go is very tough, which is why consultants always tend to get a gig. But we are starting to see those costs come down, and with the $1 billion or $2 billion on the balance sheet, the company has the flexibility to make changes, and it can sacrifice some short-term revenue for longer-term gains. So the interesting thing about Twitter, it really is a contrarian play. The Facebooks and Googles are a very easy sell. They're growing quickly. They're making plenty of money. But Twitter's revenue, I think, is up about 4-fold in the last 3 or 4 years. So it doesn't have a revenue problem. It just needs to sort out its costs. And it looks like Dorsey's finally making moves in that direction. Another thing, Trevor, who's our lead analyst on the stock, is a very high user of Twitter, and has come up with a number of items that the company should be pursuing to make the platform far more friendlier to users, trying to get rid of some of these hate speech people who are just on there putting rubbish up there basically, which detracts from the attractiveness of the platform to advertisers. And again, we've seen a move last week where Twitter's trying to really knock those people out and get rid of their accounts. So this isn't a glamour stock, but plan A for this stock is that they really get the advertising going, cut the costs, and boost the bottom line. And plan B is that if management watches this again, then there's plenty of cash on the balance sheet, and with a market cap of not much over $10 billion US compared to a market cap of the 4 FANG stocks I mentioned earlier of $1.5 trillion, you think this has got to be valuable to someone. Something I should have mentioned at the beginning, we've got a few questions already, but we're going to deal with the questions at the end of once we've gone through a few stocks in the portfolio. but please feel free to send in any questions if you like, and we'll deal with them at the end. So Wells Fargo, don't want to talk about this one too long. We've talked a lot about the case for banks, and we didn't expect Trump being the 45th president to be a bit of a trigger for the banks to perform so well as they have recently. The banks have been struggling for quite a while trying to boost their return on equity. Wells actually has virtually the best ROE of particularly of the banks of its size. But we all saw late last year that the CEO, John Stumpf, had to fall on his sword. And I think the media made this, and the point I'm really going to make is the media made out what happened with the opening of essentially false accounts much worse than what it actually was, which is not to say that Stumpf should have hung around. It was really poor management to let that situation get as far as it did over 5 years. But in terms of, I guess, quarantining the problem, the CEO's gone. He's now been replaced by Chief Operating Officer Timothy Sloan. I think there's still a question mark about it. He's obviously a good operator. He's been COO and been within the bank for a long time. But the question is, is he actually going to be able to change the culture there? So far, he's talked the talk, and we need to see him walk the walk as well. But in terms of the financial impact on what actually happened, it really was tiny in the sense of how big Wells Fargo is. 5,300 staff ended up being fired over 5 years, but that was from a workforce of 270,000. So it just shows you how big this bank really is. And if you've seen any of the Department of Justice fines that have been dealt out to the major banks from things that went on before the GFC, whether it was missold debt securities or whatnot, they've been multi-billion dollar. I mean, Bank of America had I think it was $16 billion was the final number. So absolutely huge payouts. But in this sense, with everyone coming down to Wells Fargo, their fine was only $185 million. So when you're making $5.6 billion a quarter, really it's just a drop in the ocean, which is not to go away from how important this situation was. It should never have happened in the first place. But just in terms of our investment case and our valuation of the business, nothing's really changed. Got any more comments on Wells, Wayne?
No, clearly it's not as attractive as it was 2 years ago, but the margin of safety is still there for the weighting that we have in the portfolio. We have trimmed the position somewhat since the run-up post-Trump being elected, but we still like the business and clearly has a very, very strong franchise.
Last, I might just say that this is a bank that's basically traded on its reputation for a very long time as being one of the best well-run banks with a great culture, and I think that's what really took people by surprise with the situation. But that said, the whole Wells Fargo has this idea of selling multiple products to existing customers, and people have said, well, the pressure's too much, you're just trying to sell any old product to any old customer. But we sat down and spoke with the company, and it's not what we think is a systemic problem selling multiple products to customers. It's just during life, depending on whether you're a uni graduate or you're having your first home loan or whether you need an investment product, you're going to, if you stick with your bank, you're going to have multiple products over a lifetime. You're probably going to have more the older you get. So we don't think that strategy has gone away, but clearly management's already made moves towards this. They need to fix how they remunerate people on the front line to make sure this doesn't happen again. 21st Century Fox is a company we haven't known for really all that long, but it was really sold down fairly heavily last year. People are worried about the old media versus the new media, and a lot of the advertising going to online or to the Facebooks and the Googles. And also there's question marks over the cable bills in America, which I guess somewhat similar to Foxtel in Australia. The cable bills can be north of US $100 per month. And so people are starting to question whether they really need to pay that much for all those services when they can pay 11 or 10 bucks a month for Netflix or similar stand type over the top or online services. Amazon's now getting involved. Netflix is also producing its own content, so this is another thing that's been a real strength of Fox for a long time. But we got to a point last year where if you did the maths on the business and even being pretty conservative with the numbers, you're buying essentially this business at about 9 times earnings, or at least on our numbers. And one of the big things you were getting with this business was a stake in Star India, which is just essentially a cable business in India, which is growing very quickly, has over 600 million subscribers. The company's producing a lot of content there and really growing the variety of shows across cable in India. And this is, I tend to think of India as decades behind where China is. It's not to say it's apples with apples, but with Modi in charge, we're finally starting to see some changes in China. And essentially one way to look at Fox when we bought it was that you're getting Star India for free. So it looked like in the valuation you were paying about $1 billion for a business that we thought was probably worth $7 billion and growing over time. And we're not overly excited about the stock at the moment because it's pushing towards fair value. But the point I'd make is just that even in an expensive market, if you're agile and you just focus on individual businesses rather than getting caught up in the macro, you can find these opportunities when you do the in-depth research and actually work out the numbers behind the business and actually work out what you're buying and how much you're paying for them.
There's a number of aspects that we like a lot about this business. The core Fox News ratings just continue to skyrocket. As an example, when we compare the ratings to the last US election, Fox just cleaned the plate with its competitors. The ratings were up 107% compared to negative growth. CNC, for example, dropped half its ratings compared to the previous. So Fox is clearly cleaning the floor in its Fox News. A number of the other aspects that we like is their individual content offerings really play to the pick and choose model, which we're starting to see as internet services become more prolific. Fast broadband speeds allow for over-the-top access and usage of YouTube, Netflix and the likes. And just to put that into perspective, the volumes that YouTube and Netflix use is north of 50% of all internet traffic. So it just shows how fast that over-the-top sector is growing. And a company like Fox, which has high quality content with growing ratings, will play to that very, very much, even though the distribution strategy will change compared to what it has historically done. We like the fact that the balance sheet is very clean, has a high net cash position. At the last count, the net cash is around 15 billion compared to a market cap just north of 50 billion. So we like that a lot. We like the optionality, as Nathan outlined, with the Star India asset in the largest country with the best forward demographics compared to all the Western large economies. It has the strongest prospective demographic change and will feed into that asset, we believe, in a very, very big way. And the company's been very conscious of its capital allocation. Clearly, it's another business that has a high founder operator ownership. That's a classic strength, we believe, and characteristics of the majority of our portfolio companies. And over the last 4 years, for example, the company has bought back a quarter of its shares. So we like the fact that they were buying back when it was a clear undervalued stock. So I'm not sure I've got much more to add to that, but it just highlights the type of characteristics and strengths that we have across our portfolio.
I think the content Fox has is very well suited to skinny bundles or to stay part of the bundles in the future as well. It's very cheap for all of the channels. It only runs at about $1 a month compared to $8 a month for ESPN. And people just love Fox News, for example. So we actually think it's a much better place than most people give it credit for.
Sure.
So our last stock here, before I'm going to introduce Alex, our head of distribution, is NVR. It's one of the more recent companies we've added to the portfolio. The home building industry is not one you would normally find a lot of value investors looking for high quality businesses, but this is a very unique business. I won't go into a lot of detail, but just want to show you a couple of charts which I think really tell the crux of the story. If you have a look at the returns from the home building industry in the US, you can see there's NVR and then a huge gap to get to the rest of the pack. That shows the total returns from March 2006 up until July 2015. So during the GFC, NVR was the only home builder that actually made money. And its secret sauce is that rather than borrow lots of money and have huge land banks sitting on the balance sheet, and you can imagine what happens when you get a downturn is the cash flow dries up, and then they're stuck with all this debt and land and won't sell, and that's what tends to send these companies bankrupt. Instead, what NVR does is it pays 10% down for an option on its land parcels, and that way it can develop the land when it wants, and it doesn't have to take on a huge amount of debt. And so instead of being lumbered with this debt, it's had this wonderful balance sheet where over the last 20 years, it's actually been able to reduce its shares on issue by 75%, which is just absolutely remarkable. So a couple of big tailwinds blowing behind not just NVR but the industry generally. I've talked a lot about this in the past, but the millennial cohort or population that's coming through America at the moment is the biggest population in history. We've got, you can see on the chart there, that we're basically getting to a period now where you're reaching a median age well into the 30s, where people are having families, they're buying homes, they're having children, they're buying new cars, and we've really seen that particular scenario stunted by the GFC, where the millennials and other people have put those big life decisions on hold. So we think over the next 10 years we expect to see a big increase in home building activity. And the other thing is this chart is the US existing homes for sale as a percentage of the US population. Now there's a lot of reasons for this. Obviously if you live in New York, San Francisco, Silicon Valley, Los Angeles, homes are very expensive, so you can imagine a lot of people tending to rent in those places. But right across the board we're seeing basically record low home ownership in America. And a lot of people are worried that people are going to stop borrowing money as interest rates are starting to go up. But what traditionally you tend to find is that people actually, to lock in those low interest rates, they tend to borrow before or try and get ahead of those interest rates going up. So we haven't seen that yet, but at the moment in America, in stark contrast to Australia, it makes a lot more sense to buy in most regions than it does to rent. So there's some really strong tailwinds blowing behind this industry, but we really like NVR. The returns speak for themselves. The operating model is very different. The CEO has been there for 20 years. This is a company that's been tested through the GFC, which is probably the worst test this company will ever have to face. And it's a real animal buying back shares, which is, again, another one of those plan A and plan B situations where plan A, we make a lot of money as the home building space comes back, and plan B, if the share price goes down, then we expect management to be putting that balance sheet to work and buying a whole bunch of shares. So the last slide there, how can you beat the market? This is no different to what we've been saying for a while. We haven't changed a word on this slide. So rather than go through that, I'm going to hand over to our Head of Distribution, Alex Haynes.
Thanks, Nathan. On slide 12, you'll see the quote, a rising tide can lift all boats, and certainly over the last 5 to 7 years, it's been a very strong momentum-driven market funded by cheap money. Quantitative easing, printing money, negative rates, etc. All of the central bank interventions are now starting to come to an end. We are entering a new cycle. If you believe what I've just said, then the next question begs, what should you consider in selecting an active manager to take advantage of the next cycle? We would argue a manager different from the benchmark, a manager different from its competition, i.e. holding different stocks, a manager that exhibits downside protection, and of course a manager with a proven track record over multiple cycles, not just the last bull market, of being able to create strong absolute returns for its clients. And one tool available you may not have heard of is ActiveShare. So in short, it's a way to measure the percent of a portfolio's holdings that differ from the benchmark. It's a great way to flush out index hugging managers, i.e. any manager typically below sort of 70% active share is index hugging. So you'll note that Vanguard, obviously passive, has got a very low active share, i.e. it's correlated very strongly with the index. The research concludes that a manager with high active share has historically outperformed when coupled with being able to generate strong stock selection strike rate and downside protection, and I'm very happy to supply you more information around that. And you can apply this active share tool also to your Aussie equity managers as well. Over the next slide, on slide 14, you'll see that our strategy is rated by both Longsec and Zenith. We're also, our funds available on multiple platforms have just recently been added to the IWF Pursuit platform, which we're very pleased with. We also offer a managed account service as well, and very happy to talk to you about all of those different features. So with that, I'll conclude and hand over back to Nathan for any questions.
So the first question we've got is, are the Big Four Australian banks currently sourcing large short to medium term loans denominated in US dollars from abroad? So my experience with the Australian banks is typically their wholesale funding, which is what I was referring to, is the Achilles heel of the Australian banking industry. And most of that money tends to come from Europe rather than the US. It just tends to be where the big pools of money come together to make those loans. Now, those loans are a much smaller proportion, well, at least a smaller proportion now, or at least last time I looked, from before the GFC. The banks have tried to, or they have accepted a lot more deposits, and so that makes them less risky in that sense. But this is another reason why we much prefer the banks in Europe and the banks in the US, is that they've got record capital levels, absolutely no balance sheet problems at all, low price to book ratios, but most importantly, they've already been through their housing crisis. Now, I don't know how the Australian property market is going to perform over the next 5 to 10 years, but it simply cannot continue going the way it's got, because the debt levels in Australia are just so high. I believe we're now the highest in the world, and if you look at any other country around the world, we're actually matching Canada, but we're in the levels now that have typically produced massive downturns at some point in the future. Now, obviously, ultra low rates can prevent that from happening for some time, and we've got good employment in Australia and the economy is ticking along, partly because the housing market's so strong. But at some point, the pipe is going to have to be paid, which is why we really like our overseas banks. This next one's got your name written all over it, Wayne. It's a while since we've seen any sort of correction or even a wobble in the latest surge of the bull markets. Do you feel comfortable at present about markets, or do you think the probability of some sort of correction coming soon is now elevated?
The problem with market levels currently is, in aggregate, they're very, very high. But looking under the bonnet, which is really what you've had to do over the last couple of years, there's been certain sectors which have driven those market indices to all-time highs, and there's been certain sectors which have just simply been decimated. And it's in the area where the prices are much lower than they have been is where we're doing our fishing and finding the opportunities. So moving forward, I definitely feel it's going to be much more a stock pickers market. If you're buying the ETFs that are just index huggers or just the indices themselves, I think you're running a very, very high risk. I don't believe the passive strategy over the next 10 years will be similar to what you've seen over the last 10 years. But a concentrated, selected of portfolio companies based on price to valuation, I think will do very, very well. I'm as excited about the portfolio that we have today as I have been in the last 10 years. There's just certain sectors that have been absolutely decimated. A number of our recent acquisitions are off 40 to 70% in the last 2 years, just to give you an indication of the scope of the movement. You talked about Bank of America before. I mean, here's a company, it's a large cap. It has many analysts following it. It's not like it's hiding in the shadows anywhere. The year kicked off, the stock price was $17 a share. 6 weeks later, it was $11.20, and it finished the year at $22. I mean, phenomenal movements. So if you're building and managing a portfolio based on intrinsic value assessments and then buying at a discount of that, I think the opportunity set is very, very attractive today.
It doesn't sound like much when a stock moves between, say, $17 or $18 and $11. In the case of Bank of America, that was about a US $60 billion move. So if you really still believe the markets are efficient, you might want to check some of the action lately. So the third question is, how is your investment portfolio in the United States likely to be impacted by the Trump policies?
Look, we won't add a position unless we're prepared to own it for 10 years. So we're looking for businesses that have competitive strengths, proven, not anticipated, with management that will manage that business, look after the shareholders from a capital allocation perspective, and build on that competitive advantage. We're looking for those businesses irrespective of the economic tides or who is in power at any given stage. So we have no position in the portfolio which was contingent on a Trump or a Clinton victory. We had no sense of who would win it. As it turned out, it came down very close to the wire. There's some big political elections in Europe this year, for example. Our investments in the UK and through Liberty Global, which is our broadband internet investment in continental Europe, is not premised on whether whether the Conservatives or the left wings win in the French elections on April 23rd, or whether Merkel retains her power position in Germany at the latter part of the year. We simply do not play that game. So we're just looking for businesses that we can demonstrably argue are selling for less than their long-term intrinsic value, and we will then enter that position when it's an attractive time to do so.
I think it's probably worth saying that clearly share prices have run ahead, already trying to bake in any future earnings growth from Trump's ideas. But the question is now is, will they actually be enacted, in what form and when? And so I think if you're actually looking at that as an idea, one, it's already been priced into shares, but secondly, there's absolutely no guarantee that any of this stuff is going to get done or get done soon. So it's not a game we're willing to play, and we just focus on individual business and trying to buy them cheap. So no matter who's in charge, the business will do fine anyway. So that concludes all the questions. Thank you very much for joining us today. If you have any questions or you just want to make contact, please get a hold of Alex. He'll be only too happy to take a call. Thanks again.